Hello everyone, welcome to this video tutorial. In this video, I'm going to explain the questions you had in your written assignment. So I will very briefly explain how the questions or how the problem should have been approached, and then I will show you an Excel solution. So first of all, let me share your assignment document. So this is your assignment document. I'm not going to spend much time on this assignment document or the initial problem because by this time you are all aware what the assignment was all about or what the problem was all about. Google, a business segment of Alphabet Incorporated, they are considering a new satellite project. So they have two alternative options. One is RD6, another is MK8. Both of these satellites have similar features in terms of providing the services, but they differ in terms of initial investment. Initial investment means the cost of satellite, launching cost, and these are their annual revenue, operating costs, and the project life. In addition to this information, we have some additional points here. So additional net working capital requirement at the inception of the project, irrespective of the satellite chosen. There was a technical and commercial viability cost, $50 million. The revenues and operating costs grows respectively 2% and 1% up to year 5. General and administrative costs will increase by 1 million. Advertising cost will increase by 10%, which is also 1 million. And an additional net working capital will be 5% of the revenue every year. The corporate tax rate is 30%, and the cost of capital of the company is 9%, while the project requires a 1% premium. So you are required to calculate a net present value for both the projects and so on. So let's come one by one. First of all, when you calculate initial investment, most of you did it correctly, that initial investment should include the cost of the satellite, its launching cost. For example, here the launching cost is 150 million. Its launching cost, as well as the net working capital at the inception of the project. Okay, so which means that the initial investment should be 300 million, 150, 450, and 20, so 470 million. So almost all of you did it correctly, no drama. The next question is the depreciating the initial investment. Some of you made a mistake here, that when you calculate depreciation, you only consider the cost of the satellite, which is 300 million. However, keep it in mind that what is the idea behind this depreciation? The depreciation, we charge depreciation just to match the revenues and expenses associated with an asset. Look, an asset has a 15-year of life, right? Which means that it will generate revenue over 15 years. And the depreciation is a cost against this revenue. So that also should be charged over the life of the asset, over the life of the project, so 15 years. Now, the question is it 300 million is the only cost of the asset? It is not, because 150 million, which is the launching cost, that also is a part of the cost to make this asset useful. Okay, that's why depreciation should be charged not only on the cost of the satellite, which is 300 million, it should be charged on the entire value, 300 plus 150 million, because 150 million, which is a launching cost, that is also a one-time cost, but it will generate revenue over the life of the project. That's why the cost of this project also should be spread as depreciation over the life. Okay. And net working capital should be a cash outflow at the inception of the project. Then annual revenue and operating costs, that should start from year one and continues till the end of the project. And it is said that the revenue will grow at a rate of 2% and the operating costs will grow at a rate of 1%. Okay, again, most of you did this correctly, but some of you made a mistake that this growth in 2% and 1%, you started it from year one. That is not right because it's already mentioned that 130 million and 50 million will be the revenue and cost. So that should be in year one. Then it will grow at a rate of 2% and 1% respectively in the subsequent years. Okay, that will continue up to year 5. So the revenue and cost that you have after considering the growth will continue or it will be static for the rest of the periods. The next one is a cost incurred for technical and commercial viability. I think almost all of you did it correctly, that it is a cost that was expensed last year. It doesn't have any relation with the accept reject of this project. That's why it is a sunk cost, so that shouldn't come in the cash flow estimation. General and administrative cost, again, some of you made a mistake here. Look at the information carefully. Google also incurs 5 million of general administrative cost, which is expected to increase by 1 million when the new project starts generating revenue. So this is a clear-cut information that an incremental cost of 1 million. We discussed it several times that when we evaluate a project, we should consider only the incremental cash flows. So general and administrative cost should be 1 million, and that remains static over the life of the project. Now, the mistake that some of you have made comes from the last sentence. Half of the general and administrative cost will be allocated to the new project for accounting purpose. We also discussed this point that each project will bear some of the operating costs, right? However, in project evaluation, we shouldn't consider this accounting allocation of the cost. Rather, we should consider only the incremental cost that incurs for accepting a project. Okay, so this last sentence doesn't have any relation with your cash flow estimation. That is just for your accounting estimation or for accounting purposes. Advertising expense, again, most of you did it correctly, that advertising expense should increase by 10%. So 10% of 10 million means 1 million. That again should remain static over the life of the project. The project will require a net working capital of 5%. Okay, so 20 million is the net working capital. We start with year one. Then your net working capital is 5%, requirement is 5% of the revenue. Okay, so what you do is, I will show you the Excel soon. You will start with 20 million. In year one, you calculate how much is the 5 million. So that is your requirement. The balance should be an inflow. And then in the next year, again, you calculate 5% and you compare it how much you have at the end of year one. And the remaining, if it is positive, it's an inflow. And if it is negative, means you need to make a new investment. Some of you are also confused about this last sentence. The cost of capital of the company is 9%, while the project will require 1% premium for additional risk. Look, the cost of capital of the company is 9%. Okay, we discussed it several times that a project's riskiness can be different from the overall riskiness of the company. Now, the company cost of capital is 9%. It means that reflects the overall riskiness of the company. However, for this project, an additional 1% premium is needed because this project is somewhat more risky than the overall riskiness of the company. That's why the cost of capital should be 10% for the project, not 9%. So then you go through these questions one by one. Okay, so let me share the Excel file and explain a couple of points. Okay, so here is the Excel file, and this is first of all the RD6, and you can see this is our initial investment, 470 revenue that increases by 1%. Variable cost is the operating cost which is provided, and that increases by 1%. G&A 1 million, advertising expense 1 million. So I think all of you are fine with this. So look at the net working capital. How do you calculate? So net working capital, you will start with 20 million, then this is the 5% of revenue. Okay, so you calculate 5% of revenue, and the balance should be a cash inflow. Okay, because you need 6.5 million, but you started with 20 million, so balance is an inflow. The next year's requirement is 6.63, but at the end of year one, you have 6.5. So remaining needs to be invested, and you continue this process. Okay. And at the end of the project, you recover the net working capital that you have in the last year. Okay. And so these are the net cash flows, and this is NPV. All of you know how to calculate NPV and IRR using Excel function. And this was PVIFA is for equivalent annual cash flow. You know that when two projects have unequal lives, like here we have two projects, the one has a life of 15 years, another has a life of 20 years. So they are unequal lives project. So we need to go for equivalent annual cash flow. So what we simply do is we divide NPV by the PVIFA, present value interest factor of an annuity, and we find out equivalent annual cash flow. Okay. And that is, for example, 8 million for RD6 and 4.77 million for MK8. Okay. So once again, I stop share this one and I go back to our Word document so that it becomes easier for you to understand what I'm talking about. Okay, so the first two questions I already explained, calculation of NPV. The third question was based on equivalent annual cash flow. So you just need the annuity formula, 1 divided by R minus 1 divided by R into 1 plus R power N. So that is the annuity formula. You put interest and the life of the project, get the PVIFA, and divide NPV by that figure. Okay, and you have noticed that RD6 has a higher equivalent annual cash flow. So you should provide a clear recommendation that RD6 should be accepted as it has a higher equivalent annual cash flow. Most of you, or almost all of you, did fine with the IRR calculation because you use Excel function. And with regard to the part B of IRR question, you should clearly write down that if the projects are independent and if IRR are higher than the cost of capital, then you should accept the project. And for mutually exclusive project, you should accept the project with the higher IRR. Okay. For example, IRR for RD6 was 12.21% and IRR for MK8 was 11.25%. So both the IRR was higher than the cost of capital. The project should be accepted if they are independent, and RD6 has higher, so it should be accepted if they are mutually exclusive. Now, question number 7, calculate the payback period and discounted payback period, and you have a couple of questions. So I go back to the Excel file again. You also have calculated payback mostly correctly. So for payback period, what we do, first of all, we have cash flows. We calculate cumulative cash flow and we find out where this cash flow turns positive, which means that is the payback year, right? For example, here, year 7 is the payback year. Here, some of you did is, for example, in year 7, the cash flow turns positive. So you wrote that 7 is the payback period. But what I wanted is the exact fractional year, because you can see that your year 7 cash flow is 69.68. And the unrecovered cash flow before the recovery was 54, which means that entire year 7 is not required. That's why you should use this formula. 6, which is the year before full recovery, then the unrecovered cash flow divided by the total cash flow in the full recovery year. So payback period is 6.78. You follow the same approach for the discounted payback period. However, you just need to use the discounted payback. That means the present value of the cash flows rather than just the absolute cash flow. Okay, so for finding out the present value, you just divide each of the cash flows by the present 1 divided by 1 plus R, and then you get the discounted cash flow. And once again, you get the cumulative cash flow, and you find out that what is the full recovery year, and you use the same formula that I just mentioned. Okay. Now, the other parts of the questions were, the question number C was on the basis of payback, which project should you invest? Now, if you look at paybacks here, you can see that RD6 payback is 6 and 11, whereas MKH payback is 7 and 16. So in terms of payback, we should use RD6 because it has a shorter payback period, right? If they are mutually exclusive. Now, you should explain a bit more here, right? Because it's a very simple question. So a bit more theoretical explanation was expected. For example, here, what is the except reason criteria for payback period? Here, no except reason criteria is given, but you should mention that on the basis of payback, a project is accepted if the payback is shorter than the minimum acceptable payback for the company. Okay, sorry, maximum acceptable payback for the company. For example, let's say this company has a maximum acceptable payback of 7 years, for example, and RD6 has a payback of 6.7. So this project should be accepted. Okay. And then you should mention that if both of them qualify this criteria and they are independent project, then both of them should be accepted. And if they're mutually exclusive, then one of them should be rejected. Okay. If both of them are accepted on the basis of the maximum acceptable payback and they are mutually exclusive, then one of them should be accepted. So this is how you should explain, rather than just be very mechanical. The A should be accepted, B should be rejected. Okay. Then the next question was, discuss one limitation that is common to both payback and discounted payback. There's one common limitation, that payback and discounted payback, they do not consider cash flow after the payback period, right? And the last one was discuss one advantage of discounted payback period over payback period. So one advantage of discounted payback is it does consider time value of money, whereas the payback period does not. Okay. The next part of the question is about the sensitivity analysis. So in sensitivity analysis, it was mentioned that management expects that base case scenario is still that revenue will increase by 2% and operating costs will increase by 1%. However, in best case, the revenue can increase by 3% and annual operating costs by 0.5%, whereas in worst case, revenue can increase by 1% and operating costs by 2%. So you need to do the sensitivity analysis. I was a bit disappointed that many of you made a mistake here. Many of you missed the key idea behind the sensitivity analysis. In sensitivity analysis, what we do is we change one of the variables to see the impact on NPV. Okay, now you have two variables here. Those are subject to change. One is revenue, another is operating costs. What many of you did is when you are calculating NPV, for example, you are calculating best case, you incorporated both of them together. When you are calculating worst case, you are incorporating both of them together. That is not a right approach. Okay. So what you should do is, for example, when you are talking about best case, there should be a revenue based case. There should be a cost based case. So in revenue based case, you consider that revenue will increase by 3%, but cost will still be the base case, which is 1%. In cost based case, you consider that cost will increase by 0.5%, but revenue will again be the base case, which is 2%. Okay. So for example, here I show you that this is revenue based case. So I consider that revenue increased by 3%. Okay. Revenue increased by 3%, you can see, but cost still increases by 1%. Okay, because that is the base case. And the revenue worst case is, here I consider that revenue increase by 1%, but cost also increases by 1%. Okay, but that means cost is again the base case. So here, revenue base case, revenue increase by 3%, and revenue worst case is revenue increase by 1%, 3% and 1%, but cost remains the same as the base case. In the cost-based case, look that we consider that cost increases by 0.5%, okay, and cost worst case, cost increases by 2%. But in both of these cases, revenue again remains the same, the base cases, okay. But what you did is, in many cases, many of you did is, for example, when you are considering worst case, you take that cost increase by 2% and revenue increase by 1%. So both worst are put together. So that is not the right approach, okay, because the reason they're not right approach is the main idea behind the sensitivity analysis is we do sensitivity analysis for multiple variables, and we see that to which variable the NPV is most sensitive to. So if you put both two variables together in your NPV calculation, you cannot say that to which variable NPV is more sensitive. Okay, so that's the mistake many of you made. And when you explain the result, you were again very mechanical. That best case NPV is this, best case is this, worst case is this. Well, that is not the explanation of the result. We can see that this is your result, right? And what many of you wrote that, okay, in best case revenue, NPV is positive, in worst case NPV is negative. Again, we can see that. This is not the explanation of the result. When you explain the result, you try to bring something new that you haven't shown in your NPV calculation. For example, what you could do is you could calculate how much the NPV changes in percentage from the base case to the worst case, revenue worst case, cost worst case, revenue best case, revenue worst case. Okay. The idea is, in this case, as you calculate the percentage change, you can argue that NPV is more sensitive to, for example, revenue, or more sensitive to cost. So that is what you bring up. And you should write down a managerial implication that since NPV is more sensitive to, for example, cost or revenue, so managers should be more careful, more cautious when they are estimating or they are forecasting the revenue or cost, which is NPV more sensitive to. Okay. So that was the sensitivity analysis. Then question number 7, I would say that most of you did pretty well in question number 7, where you required to collect the stock prices of Google, S&P 500 index prices, you estimate a regression, calculate beta, then calculate cost of equity, recalculate NPV using this cost of equity, and discuss the result. So most of you did it right. Okay, so no drama with this. Just a very few of you made some mistakes. So let me explain that one. What you did is you got the prices of Google and S&P 500 index value, and you ran a regression. Okay, now look, what is beta? Beta calculates that if market return changes by some magnitude, how much an individual stock return changes. Okay, so beta should not be calculated based on the prices, rather beta should be calculated based on return. That's why from the price, you should calculate return first, then you should estimate the regression. I think most of you were fine with the other questions here. And the last one is question number 8. Many of you struggled a bit with question number 8, but later most of you did it correctly. Google has decided to fund 50% of the project by issuing perpetual bonds, and Google is currently rated AAA. AAA rated bonds carry 1% default spread. Look, we learned about this default risk earlier, and we discussed that when a bond has higher default risk, it should have a higher coupon rate. So this is a pretty straightforward information. I think some of you couldn't get this though, that long-term treasury bond rate currently is 6%. You know that treasury bond is risk-free, whereas this is a corporate bond issued by Google. It has a default risk and it should have a 1% default premium, which means that the coupon rate should be 7% and the discount rate is 8%. So what you need to do is, let me show you the Excel again so you understand what you should do here. So look at this. You need to assume a face value of a bond, let's say $1,000. Coupon rate is 7%, I already mentioned. It is also mentioned that the coupon will be paid semi-annually, right? So semi-annual, annual coupon payment would be 70, so semi-annual coupon payment is 35. And discount rate should be 8% annually, so 4% semi-annually. Some of you also made mistake here. They use this rate interchangeably. Like you used 8% as discount rate and 7% as 8% as the coupon rate, 7% as the discount rate, which is not correct. Then when you calculate value of the bond, some of you also made a mistake that used the normal bond valuation model, that present value of interest plus present value of principal. So probably you ignored the information. It was mentioned that it is a perpetual cash flow. So, it is a perpetual bond. So perpetual bond means it will generate a perpetual cash flow. So no principal, no maturity, which means that this coupon payment $35, that is your perpetual cash flow. So you should divide it by the semi-annual discount rate, which is 4%. So can you remember the present value for perpetuity, which is cash flow divided by discount rate, and the value of the bond is $875, right? Our initial investment is $470 million. 50% will be financed by debt, so you divide it 235. So as you divide 235 million by this value of bond, you find that 268,571 bonds will be issued. The second part was to calculate WACC, weighted average cost of capital. Most of you did it correctly. So cost of debt is the coupon rate, which is here 7%. Proportion of debt is here 50%. Cost of equity, you should use it, the one that you calculated in the last question, and proportion of equity at a tax rate is given. I think it is 30%, so it's all right. And then you calculate weighted average cost of capital. Okay, so I mostly look at the approach that you have followed, and then I provided you marks if the approach was all right. Okay, so this is how you solve these problems. So in this video, I tried to explain how each of the questions in your assessment should have been approached, and I showed you the Excel. But after that, if you still have any confusion or any concern about any of the question, and you want to know more about the answer, just send me a quick email. Okay, so thank you very much for watching. Goodbye.